All right. Good evening, everybody. Happy Monday, and welcome to another episode of the Griebentrog Stock Market News. My name is Elias Griebentrog, and I'm the founder of the Griebentrog Stock Market News, which is basically a podcast in which I summarize and explain every trading day so that you can spot the bull in every scenario. Now, this YouTube channel is a new concept that I thought about. What I do here is I upload a question of the day every weekday, in which I answer a question that is highly relevant and highly applicable to the economy and markets in general. Now, I haven't uploaded last week because I was on vacation, but today we are back with another topic that I am very, very passionate about. I say that often here, but I just love standing here and presenting and talking about these topics. Now, what we're going to be doing today is we're going to talk about the Federal Reserve. We're going to be talking about a crucial turning point that the Federal Reserve will face in 2023. But we will also talk about the Fed trilemma, which is becoming an increasingly bigger problem. And we will talk about the recent events in the banking sector. Now, before we start, I'm going to explain to you in a nutshell the Fed trilemma. Now, the Federal Reserve has three goals. They want to ensure price stability, right? That is the first goal of the Fed. But at the same time, they want to ensure financial stability, right? Financial stability. And they want to ensure full employment, right? And they use the policies and the tools they have to ensure these three goals. Now, if you look at these three goals right now, you realize, obviously, price stability is the biggest problem at the moment. We don't have price stability. Inflation is way too high, and it is far away from the 2% target. Now, we are seeing some deterioration in financial stability. If you take a look at the recent events in the banking sector, which I will talk about in a second, and full employment is not a problem right now. The recent labor market report for April showed that the unemployment rate fell to 3.4%. Now, why did I choose to report about this topic now? I think that is worth mentioning. The recent events in the banking sector, they have made this Fed trilemma a bigger problem because we are starting to see some deterioration in financial stability, and price stability is still a problem. Inflation is still way too high. So the Federal Reserve will most likely in 2023, we don't know how soon, will likely face this scenario where they have to choose between really beating inflation by bringing it back to 2% or ensuring financial stability by loosening monetary policy. Now, before I'm going to dive more deeply into this topic, let's talk about the recent events in the banking sector very quickly. Now, the recent events in the banking sector are just in a nutshell. I'm not going to explain it in great detail here, but they're basically two building blocks, right? That explain these events, these problems that we're having right now. One building block is obviously a decrease in demand for loans or lending in general, right? A decrease in demand for lending, right? Due to higher interest rates, obviously they increase lending costs. So the demand for lending decreases. Now, the second building block of the recent events is on the supply side. Less supply of lending. Now, why do we have this decrease in supply? Well, one reason for this is obviously deposit outflows. When interest rates rise, the yields on, for example, 2-year Treasury, 10-year Treasuries, it increases, and it simply makes leaving your money in deposits less attractive. So people are moving their money out of deposits and into money market funds. Now, if this happens too rapidly, the banks, they will have a lack of funding, right? They will not be able to insure all deposits. So what they do is they, for example, offer higher CDs, right? That is one thing they're doing, or they have to lend money from these expensive Federal Reserve lending institutions, which charge very high interest. So these two problems, what they do is they decrease net interest income, and they put pressure on net interest margins. And when net interest income of regional banks comes under significant pressure, you will see a decrease in credit availability. You will start to see the first signs of a potential credit crunch, which is very problematic for the economy, which will put a lot of downward pressure on economic growth. But in turn, that will also put downward pressure on inflation, right? Now, Another reason why I chose to report about this now is so while we are seeing some of the deterioration in financial stability, we are also seeing incredible resilience in other sectors of the economy. Okay, so what topic am I going to talk about first? Yeah, let us continue to talk about financial stability very quickly. Now, obviously, the collapse of Silicon Valley Bank, JP Morgan having to acquire First Republic Bank, those are problematic situations, right? And those are an effect of tight monetary policy and rising interest rates. But are these events still idiosyncratic, or are we truly starting to see a credit crunch? Well, if you look back at last week, what we have seen is an increase or a very strong sell-off in Pacific West shares, right? Pacific West and also Western Alliance, right? Those two banks, we have seen a significant sell-off. The shares were down 50% on a single day. At some point, they have rebounded now. Now, the question I asked myself was, why are these banks so under pressure right now? If you look at their balance sheet, they have a much higher amount of insured deposits compared to Silicon Valley Bank and First Republic, and also the asset side of their balance sheet is much less dependent on securities. So they're in general in a much better situation than the other banks that we have seen come under significant pressure. So why are markets so? Why have we seen such a strong sell-off in those shares? Well, the reason is we're in a confidence crisis right now. So I definitely believe that in the regional banking sector, in the banking sector in general, some confidence needs to be restored, but not the Federal Reserve doesn't have to step in by using monetary policy. I believe the separation principle still holds. For example, the FDIC could consider raising the deposit insurance limit above $250,000, which they also have done, right? When they took care of Silicon Valley Bank and First Republic, they did also insure deposits above $250,000. But if they would do this for all regional banks, that would restore a lot of confidence in the sector. But my message here basically is, most regional banks, they still have a pretty healthy balance sheet, right? Of course, we have seen strong outflows in deposits, but those outflows are starting to stabilize. Deposits are starting to stabilize. Most of these a lot of banks have reported relatively good numbers. Pacific West, Western Alliance, both banks said they have enough liquidity to cover all uninsured deposits. And at the same time, they have not seen a significant increase in deposit outflow since JP Morgan acquired First Republic Bank. So maybe this is not such a big problem yet, because we see a lot of banks still reporting good earnings in general. So maybe this is more of a confidence crisis now in reaction to the collapse of Silicon Valley Bank. So we are seeing, obviously, like I said here, because we are seeing that interest income come under pressure, we are seeing some credit tightening, narrowing of credit availability, which will obviously have some effect on economic growth in general. But this might not be such a big problem yet. But we cannot underestimate it, obviously. So we have to keep a close eye on this. Now, on the other hand, if you look at inflation, right? Inflation is still incredibly high. The recent core PCE report showed that core PCE was basically, it grew by the same amount. So it is very sticky at a high level. Now, the most interesting data point that was released recently was the labor market report for April, right? Unemployment rate fell to 3.4%, and payrolls coming in at above 200,000, even after the revision that we have seen for April. So the labor market is incredibly resilient, which has, of course, inflationary pressures. Let me put some perspective into this payrolls number that was reported. Payrolls above 200,000. During 2019, the unemployment rate was very low. It was at 3.5%. And that was 2019. That was a period of economic growth. Nobody was worried about potential economic weakness. During this period in 2019, during that period of economic growth, the average 6-month payroll number was 167,000, right? That is much lower, more than 43,000 lower than the current payrolls number. So that just puts into perspective how resilient the labor market is. In addition to that, if you look at the current GDP level, we're basically 1 million jobs short, right? Now you need to ask yourself, where are we missing those jobs, right? Because we are seeing some weakness in interest rate sensitive sectors of the economy, for example, manufacturing, for example, housing. So where are we seeing the strength? It is in the service sector. The service sector is the engine of job growth at the moment. We are basically 1 million jobs short in the service sector. Now, the problem with the service sector is, and this is why I'm bringing this up, the service sector is insensitive to rate hikes, to interest rate hikes. And that is what happens, like Mohamed El-Erian said, that is what happens when you let inflation migrate from a few goods to the service sector as a whole. Inflation becomes stickier, growth, economic growth becomes stickier, and that makes it harder for the Fed to restore price stability by bringing inflation back to the 2% target. So generally speaking, we are seeing incredible resilience in an interest rate insensitive sector. And if you look at the consumer in general, traveling abroad in the US or traveling abroad from the US is at a historic all-time high at the moment. It is at an all-time high. If you look at the current earnings season, about 80% of the S&P 500 has reported earnings that beat expectations. You see companies like Procter & Gamble, Pepsi, Coca-Cola, McDonald's, all of these companies are still able to raise their prices without reporting a significant decrease in sales volume. So companies are still able to pass on higher prices to consumers. They're able to keep increasing their margins. So what does this tell us? This tells us the consumer is incredibly resilient. Now, why is the consumer so incredibly resilient? The consumer is resilient because the labor market is incredibly resilient. So I believe it is evident that we must see some weakness in the labor market in order to restore price stability. But the labor market strength is in this, we're basically seeing that strength in the service sector, and that service sector is insensitive to rate hikes. We are seeing this strength in the service sector. And because that service sector is insensitive to rate hikes, the Federal Reserve will have to keep rates at a higher level for longer in order to cause the service sector to lose weakness and hence allow the Fed to restore price stability or bring inflation back to the 2% target. So generally speaking, this inflation problem is obviously a much bigger one at the moment than financial stability. But these events in the banking sector, they do show that we're starting to see credit conditions tightening. So in 2023, I believe the Federal Reserve will have to choose between those two paths. Will they ensure price stability by acknowledging or by accepting that inflation, by tolerating that inflation is at a higher level now? Or will they continue to be on this path of restoring price stability and kind of ignore the deterioration in the financials, the deterioration of financial stability? And if you look at the general, if you look at the most previous press conference from Jay Powell, he did say that JP Morgan acquiring First Republic Bank will draw a line under the recent events in the banking sector. So it is kind of, he believes that these events might actually be idiosyncratic. But I just believe this will be an increasingly bigger problem. And throughout 2023, the Fed will have to choose between those two paths. Now, the problem is we don't really know what the Federal Reserve will choose because the Fed, they don't have a strategic outlook. And that is why we have seen such immense volatility in the 2-year Treasury yield, which makes it very hard to value equities. Because how are you going to calculate your equity risk premium if you cannot value risk-free security? And usually the 2-year Treasury yield is anchored to the strategy of the Fed. So the fact that the Fed doesn't have a strong strategic outlook makes it very hard for us to anticipate what path the Fed will pay more attention to, what data point will be more important for the Fed. But generally speaking, right now, given such a resilient service sector, which is insensitive to rate hikes, I believe the Federal Reserve will have to keep focusing on inflation. Now, Jay Powell did say that the current outlook of the FOMC does not support rate cuts this year. So it will be interesting to see how this further develops and what path the Fed will choose in 2023. Because simply ignoring this factor, if it becomes a severe problem, you cannot ignore it, right? You need to do something about it when you start seeing a credit crunch. So like I said, it will be very, very interesting to see. Now, people tend to ask me, Jay Powell, right? He keeps on talking about getting rates to a sufficiently restricted level. And people ask me, Elias, what does that even mean? So Jay Powell basically has an arithmetic, and BlackRock has reported beautifully about this, the Jay Powell arithmetic. It is very, very interesting, and it gives you an idea of the way Jay Powell is thinking at the moment and what he means by saying getting interest rates to a sufficiently restricted level. Now, the Jay Powell arithmetic is basically you take the nominal rate, right? You subtract 3% inflation to arrive at a real rate of 2%, and you add to that the effects of credit tightening, right, on the economy, on inflation in general, and you add to that the effect of quantitative tightening, right, which are increasing this real rate here. Now, the question is, of course, you cannot put a value to credit tightening. You just know, is it going in what direction it is going? Are we seeing an increase in tightening of credit conditions? Quantitative tightening is the same thing. It is hard to put a numerical value to this. But and another question remains: is the 3% inflation level actually the correct one to use, or is it is inflation much higher? Indicating that the real rate is actually not this high, right? So this is kind of the Jay Powell arithmetic, but even within this model, there's a lot of uncertainty. So I still believe that the Fed is missing the strategic outlook. I believe at this point I've said everything. It's really I love standing here and talking about this stuff because it is incredibly interesting. The Federal Reserve is extremely data dependent at the moment. It doesn't really have a strategic outlook. So we will have to keep paying attention to what story the data is telling us. And based on that, we'll have to continue to interpret the meaning of those data points for the further development of monetary policy. So this crossroad here is something that I will keep talking about in 2023. It is something that I will keep writing articles about. I will also keep talking about this Fed trilemma becoming an increasingly bigger problem. But other than that, I think I've said everything that I wanted to say in today's presentation. Like I said, new question of the day is released every weekday here on this YouTube channel. If you want me to answer a certain question, right, just shoot me a message, write it in the comments, or just contact me over LinkedIn. Elias Laurin Kriebendruck is my name on LinkedIn, economics student, and you can just shoot me a message there. Now, do make sure to tune into our podcast tonight, in which we will summarize and explain the entire trading day for you. I'm not really up to date at the moment, been busy studying today, so I still have some catching up to do on today's market-moving events. So I hope you enjoyed today's episode of the Kriebendruck Stock Market News Question of the Day, and I hope that I will see you back here tomorrow and tonight. Have a great evening.